Today, our head of emerging markets, Mike Sell, will share our emerging markets outlook for this year and why we are contrarian and excited about the asset class in 2025. The presentation will be followed by a Q&A session. Without any further ado, Mike, the floor is yours.
Great. Good morning, good afternoon, everybody. Thank you very much for joining us. Firstly, just to introduce myself and the team. I'm head of emerging markets here at Alquity. I've been investing in the asset class for almost 30 years now, and I'm the fund manager of the GEM Fund and the Asian Fund, as well as our Indian Fund. Mani is our other very senior fund manager who has, again, a similar amount of experience and helps us with portfolio construction. And then Dan and Kieran are the other two stock pickers alongside myself as well. So we're multidisciplined, very stable, and we've been working together for over 6 years now. And all of us have been involved in emerging markets for all that time. So without further ado, let's move on to the next slide and talk about how we see India and emerging markets in a Trumpian world. And on the next slide here, this has always encapsulated how we see emerging markets. We believe they should be focused primarily on the beneficiaries of domestic structural growth. They should not be a beta trade on global growth, which is how many people see emerging markets. So let's look at some of these structural themes in a bit more detail. Firstly, on the left-hand side, this is the Indian population pyramid split by households. In 2021, 77 million households were in the high or upper middle income areas. They're the consumers, if you like. That is forecast to rise by 100 million households. That's almost 400 million people by 2030. That creates a huge number of new consumers, more than you have in the EU or the US combined. And that structural growth benefits property companies such as Loda, or similar story in Indonesia, and Mitra Adipakasa, one of the leading Indonesian retailers, would be a beneficiary. So the demographics is the first underpinning. The second is e-commerce. This shows e-commerce growth in 2023, and you can see that in Indonesia it was over 30% and not far behind in India or the Philippines. China, much slower, but this is a continued structural driver, the shift from the physical to the online world. And C in Singapore and all of ASEAN, and NAVA in Korea would be structural growth beneficiaries of this. And then leisure. The chart on the right-hand side shows that travel is growing twice the rate in Asia than it is in Europe. People have more money, they have more leisure time, and critically, the infrastructure is better. All this means that the growth we're seeing in the travel sector across emerging markets, but particularly in Asia, is very structural and very fast growing. So Lemon Tree would be an example in India, or Cebu Pacific, which is an airline in the Philippines, would also be an advantage. So these are the kinds of structural themes that we like in our portfolio that are very domestically focused. And so we expect on the next slide our portfolio to thrive during the Trump presidency. But very critically, this is the year for active managers. Not everywhere will do well. So let's have a quick look around the world. And let's start in America with Mexico. Mexico is the exception. 33% of GDP is accounted for by exports to the US. They are really in Trump's firing line, and we have minimal positions there. They could be a big loser. Brazil doesn't have that sensitivity to the US, but has its own problems. The economy is overheating, and we're seeing rapid interest rate increases in contrast to the rest of the world. So there's negatives there for sure, and we're very underweight both those. In contrast, Argentina is now reaping the benefits of the reform, and so that's an area that we find interesting. And similarly, on the reform story now having a positive impact, Egypt in the Middle East, again, has gone through some terrible times, but that is now beginning to bear fruit. So that is an attractive area. Elsewhere in the Middle East, GDP in Saudi Arabia is expected to go from about 1% to 4% this year. Amazing demographics and reform. The UAE, fast growth, another area that we've been adding to. In Eastern Europe, Greece is had a lot of pain over the last decade, and that is now benefiting from that being in the past, and the structural reforms are bearing fruit. Greece is expected to grow at twice the rate of the Eurozone. It doesn't need the interest rate cuts that are coming, but it's going to get them anyway. And so that's hugely positive, particularly for the consumer sector. And Poland is growing 3 times the rate of the Eurozone. Again, a lot of opportunities there. And at the bottom of EMEA, South Africa, we now have a sensible reformist government in place. GDP is accelerating, inflation is coming down, interest rates are coming down. So Eastern Europe, Middle East, and Africa, in contrast to Latin America, look really, really exciting. Moving across to Asia, starting with China. China has improving growth and cheap valuations, but it's a politically driven stock market, and the geopolitical issues with Trump are well publicized and are not going away. So we're very cautious there, focusing only on high quality private sector names that are domestically growth focused and not exposed to exporting to the US. The vast majority of our portfolio is domestic. I've said it many times. The exception is Korea and Taiwan, where the semiconductor cycle is being supercharged by AI, and that benefits both those countries immensely in terms of the tech sector, which is where we have our positions. Now, tariffs make no sense here. It takes 5 years to build a semiconductor plant in the States. So putting a tariff on just hurts yourself. So it's at the lower end of the risk range. And the news this week about DeepSeek in China and what that means for AI, I think it's far too early to tell. It's possible it means we need less expensive data servers, but we have faster adoption of AI on individual devices. So there'll be some nuances around how AI is adopted, but the winners are still going to be in Korea and Taiwan, regardless of whether this all proves to be a storm in a teacup or it does represent a seismic shift leading to faster adoption. Coming to ASEAN, ASEAN has amazingly strong growth stories. The Philippines, reform, Indonesia, Thailand, reform, cheap valuations. This has been masked by the stronger dollar. That will end at some point, and then people, like last year, will realize the opportunities here and see the value. Vietnam, we're a little bit more cautious. Like Mexico, about a third of GDP is accounted for by exports to the States. So we have minimal positions there because of that risk. And then India. India is the standout large market that looks really, really attractive now and within the new Trump presidency. It's uncorrelated to other markets. The growth is driven by demographics and the shift from the informal to the formal sector. And exports to the US are only 2.7% of GDP, a fraction, 10% of Mexico or Vietnam. So India still looks really positive. So for us this year, it's a year for active managers, as you can see by our very different positioning versus the ETF. And domestic growth, non-traditional markets, and AI beneficiaries will drive the portfolio. So now having talked a little bit about India, let's do a deeper dive on India in the next couple of slides. And our dedicated Indian fund really focuses on India's dynamism and domestic growth. Building India, whether it's pipes, wires, cement, this is a structural story. Retail is about 14% of our funds, much more than what you see in the index, our peers, or the ETF. The growth there is going to be multi-decade. And travel is about 1% of the index. We're seeing 20+% top line growth for companies, whether that's the Indian version of Expedia, whether it's hotel companies. Indians love to travel. They have more time, they have more money, there's more of them, so the demographics really work. And Modi's infrastructure means it's now physically possible in a way that it wasn't 10 years ago. So our Indian fund is more geared to these structural themes than others. We're also focusing on the next story, not the last. We have some mega caps, as you can see on the right-hand side, But also we have a number of smaller companies that really play into the themes that we talk about, making the portfolio very unique. 20 of our 42 names are not in the index, and 39 of them are domestically focused. And as we've said, India is about the Indian domestic story. It is as immune as can be from what's going on elsewhere in in the world versus other emerging markets. Now, India's come off a little bit lately, which is why this is a really good opportunity to talk about it. On the next slide, the bad news in terms of slower growth in Q2 is in the price. The upside is not. So firstly, we're expecting interest rate cuts to commence relatively soon. Inflation is well controlled and has come down. It's a matter of time, whether it's in about 10 days' time, whether we have to wait to April. We're nearly there for the first cut. Budget day is on Saturday. There are no expectations being built in there. We'll have to see whether we see some pro-growth and pro-investor measures. Foreigners have taken money out of India. We think this will come back when people realize that China hasn't fundamentally changed. There are still many, many issues there. And the higher risks in China, Mexico make India a relative safe haven. So we see that reversing as well. And India suffered as people extrapolated falsely the weak GDP growth in the second quarter. That was caused by a number of one-off factors, both the weather, the timing of the festival seasons, the elections. And our view has been that we're going to see a strengthening of growth into November, December, into this year. And that's what we're seeing. That's been confirmed by HSBC's leading indicators, Credit NA's leading indicators. And we're now in results season, and some bellwethers like the biggest shopping mall operator, Phoenix, has seen an acceleration in consumption growth in the last quarter. Macrotech, which is a leading property company, their pre-sales grew over 30% in the last quarter versus 20% in the previous half. The largest private sector bank grew 15% with no issues with non-performing loans. The hotel and leisure companies seeing very strong growth. So we see this pullback as unjustified. The structural story is intact, and there are also many short-term potential positives to bear in mind as well. This is why we like India, both obviously in our Indian fund itself, but also within a GEM context. So now let's broaden it out from India to the rest of emerging markets. This chart is the trailing price to book of emerging versus developed. We've never been this cheap. We've derated for years, and we are super cheap for what we are given developed markets. Well, many people say, well, yeah, it's a value trap. I know it's cheap, but I'm not going to make any money. So the chart at the top shows the return in sterling of various asset classes last year. The US was great, gave you a 27% return, amazing. Actually, the next thing was our fund, giving you a 14% return in sterling. You made decent money in Alquity Future World Emerging Markets last year, better than actually in the Russell 2000. The India fund was not far behind, ahead of Japan, the UK, Europe. So although we're cheap and been cheap for a reason, you are actually last year making good numbers, good returns in emerging markets as a whole. And as with India on the next slide, the bad news is clearly discounted, but the upside positives are being entirely ignored. This is why we talked about being contrarian and going against the herd in the title of this webinar. Emerging markets aren't popular, but there's a lot of really good things going on and a number of potential catalysts. So interest rate cuts. There's going to be some in the US, less than we thought, but they're still happening, and we're seeing them feed through now into emerging. Indonesia cut rates the other day, India, as we've just talked about. The dollar will stabilize at some point, and that's really good for ASEAN and the asset class as a whole. Maybe there's a parallel with Trump's first term, where once we get to inauguration, the dollar becomes much weaker. We'll see. The USA is doing amazingly. We're not saying sell America, buy emerging. What we are saying is, after America, where do you want your growth equities? Do you want it to be in the UK? Do you want it to be in Europe, Japan, or somewhere that is really cheap, that has strong growth, and the underlying fundamentals are not being driven in our portfolio by what you're seeing globally. And the valuations clearly reflect the negatives, but we would argue that none of the positives are being considered. So on the next slide, what does our GEM fund look like? 33 of the 78 positions are not in the index, so we look nothing like the ETF, a year for active managers. 66 of the positions are domestically focused. This is the asset allocation at the end of December. We have around 20 markets, and many non-traditional markets are in there. It's a multi-cap approach. We have some mega caps, but also we have a large number of smaller cap companies, which we think are uniquely positioned to benefit from the trends that we see. And in terms of valuations, our fund is not only cheaper than that of the ETF, we have a higher return on equity and faster earnings growth. These three things are a very powerful combination, we believe, going forward. Now, I've talked about domestic stories. Let me like to give you a few examples on the next slide. Whether it's a Brazilian software company called TOTUS, which we think will do very well in this challenging macro environment, or the leading Polish construction company called Budimex, that will do particularly well if the Ukraine war ends. Forlis is a leading Greek retailer, Editar, an Egyptian bakery, Budget, a Saudi Arabian car hire company, HomePro, DIY, home improvement in Thailand, Housing Finance in India, retail of pharmacies in Vietnam, Indonesian sportswear and general retail through Mappy. Even in China, Tongcheng Travel, online travel, domestic structural growth. These are the kind of names that we have. You don't really see them in other portfolios or indeed the ETF very much. And they're focused on that domestic story we've talked about. On the next slide, we're very well known for our ESG, and we absolutely don't compromise on that. We believe that ESG gives you better returns. The G bit is particularly important and is something that adds value, and I think is overly ignored by, unfortunately, many of our peers. There are 4 names in the top 10 of the ETF that we won't invest in for ESG reasons, such as Alibaba and Samsung. And looking at India, Adani has received a lot of press and the share price has collapsed. This is because the leader of Adani has been indicted for bribery. We've never owned this company because the governance risk was always too high. So the G bit of ESG, we think, is crucial in emerging markets for helping reduce the risk and helping to avoid the landmines going forward. And we never compromise on that. So on the next slide, how have we done? Well, the blue at the top is our GEM fund, the Future World Fund. We're top quartile over 1 year, second quartile over 3 years, and since the end of August 2020. That's the point where we enhanced and changed our team and our process. So everything I've talked about started on that date. It's almost 5 years now, and we have less volatility than that of the index. Our Asian fund, very similar story, actually slightly better numbers, the same principles, the same themes. And in terms of India on the next slide, the 10-year number is top quartile, as is the 5-year number. The nearer term period is very consistent. There is a 12-month period ending August 24, where we underperformed because our quality growth names underperformed the low quality state-linked companies. That's really rare, happens only 30% of the time, and never by that magnitude. So we don't chase it, we stick to our process, and we know that small cap, where we have a bias, outperforms 80% of the time. So you have a blip there, but before that, after that, we are top or second quartile, and over 5 and 10 years, we are too. We've won awards for our Indian fund, for the ESG, for the performance, and we focus very much on new India and the best of India in ways that we don't believe you can get elsewhere. So finally, on the next slide to conclude before we move to Q&A, we believe that sentiment is overly bearish on emerging markets and India. It's time to think about being contrarian and look at the upsides, the positives, as well as the very well-known negatives. We focus on domestic structural growth, plus AI beneficiaries in GEM and Asia. ESG is critical for us as a risk mitigation tool. We've delivered strong numbers across the funds over the last few years, and we're highly differentiated versus our peers and versus the ETF, and operate a multi-cap approach. So we're really excited about the opportunities that we see for our funds, despite the negative news about emerging markets and the Trump presidency. And hopefully today has offered a counterpoint to the pervading sense of bearishness out there. So Mark, let's please go straight to Q&A.
Thanks a lot, Mike. Obviously, you know the principle. You have a tab at the bottom of your screen, Q&A, you write the question, and we will start with one question. What has been your best idea in 2024? And what do you think will be your best idea for 2025?
So the best idea last year was the Latin American version of Expedia. Latin America is a little bit late to online travel. There's much more of the physical market to be captured. The company in question, Despegar, was significantly cheaper than other emerging market peers. Strong structural growth theme, and that was one of our best ideas for last year and certainly delivered. Unfortunately, it got taken out by another company because they also saw the potential as well. So we had to exit the position, but that was probably the best idea last year. This year, it's going to be a number of smaller ideas that are going to deliver the performance. I think potentially in the Middle East, I think there's a number of interesting structural stories that we have. I also think that Eastern Europe is an appreciated region for this year. South Africa did pretty well last year. We think that probably continues. And obviously the big one is India, particularly the cyclical domestic names that we're in, the pro-growth names, where they've had a bit of a correction over recent weeks. And we think the market is completely misunderstanding the situation. The data is coming through to support us, and we think that will be a powerful driver of performance for this year as well.
To go further on the question, what have been the worst pick last year?
So in terms of things that didn't work, there's been nothing specific at a country or a sector level. I'm pleased to say that in 2024, attribution for every single region was positive. Obviously, China is very volatile, and that's something that we always have to continue to watch. I think Bangladesh didn't deliver for us, given the political environment that we saw there last year. So that was disappointing. And the other area would have been ASEAN. Now, we talked about it on the map slide. The growth there is strong. We're seeing reform. But last year, the stronger dollar dampened sentiment. And then that changed in the third quarter, where we saw investors begin to see the value and the growth and the reform, and we saw a very strong rally. Unfortunately, Trump coming to power then dampened that down, and we went right back where we started. So ASEAN didn't play out due to global macro issues. We've stuck with the positions. It's a key overweight for us, and as soon as the dollar stabilizes, which we expect to be not too far away, then we think the opportunity there will present itself once again. So ASEAN was probably the biggest single negative last year, putting it all together.
Thanks, Mike. You mentioned that you are negative towards Vietnam, despite their massive demographic growth story. Why?
They've built an export-driven economy, and that's great, but not in an era of aggressive tariffs being potentially placed on countries that have a trade surplus with the States. And Mexico is very well known as sitting in that camp, as is China, but so is Vietnam. 33% of their GDP is accounted for by exports to the States. And so whilst the demographics are good, the domestic story is great, we halved our position to about 1% just because the tail risk of tariffs being imposed is significantly higher than other countries such as India. or Greece or Poland, and therefore we just have a much better risk control of that. We still own a property company, and we own a pharmacy retailer, which obviously have no sensitivity directly to what's going on. And Vietnam has potential upsides, being classified as an emerging, not a frontier market. We don't care. We buy the best stocks regardless, but that clearly will be positive for fund flows. So it's appropriate to have some, but we mustn't forget about the risks as well as the potential rewards.
Thanks, Mike. Regarding the Chinese allocation, obviously Trump and China, we don't know where it will go, and actually the things might go better. So, and maybe the Chinese equities will rally. How do you see this possibility?
The difficulty with China is the volatility and the unpredictable nature of it. We are really good fundamental investors, and China domestically isn't ruled entirely by fundamentals. It's determined by Xi and the politics, and add the geopolitics on top of that. So we think you will get rallies and crashes, and the volatility will be quite high. Now, that happened last year as well, and you saw a very strong rally in China in the autumn. And our portfolio is deliberately constructed that when that happens, we're underweight, but we won't get left behind. And in the way down, we're underweight, and therefore that will help us. The knack is to have a very well risk controlled weighting, and we're at about 19% or so for China. And within that, to own high quality private sector stocks. This means that when you saw the volatility that we did see last year, and we would expect to see again this year, we don't get buffeted one way or the other. We think of it as a separate bit of the portfolio, and we will make way more money elsewhere in emerging markets. So I think we got the balance right. The proof certainly is in the performance numbers, and it's to own good companies, but not to take too much risk in China, given the reasons you mentioned.
A question about currency. Obviously, yesterday the Fed meeting, Powell was really hawkish. What will be the impact of US dollar if actually there is no cut rate? And also, rupee is at its cheapest since a long time. What will be the impact for your Indian allocation? And maybe if you can also have an overview on for the other markets, how it will impact the portfolio. Thanks.
So since Trump was elected, the dollar has been very, very strong. And the question is, when does that stop? Is all the news about higher for longer US rates in the price? Do they not cut at all? Do they cut a little bit? And our view would be that we're largely there. You know, everyone knows this. This is not new and is already reflected. So we would expect to see some stabilization in the dollar, and potentially some weakness. Trump wants a weaker dollar. Can he achieve it? When will it happen? These are unknowns. But again, being contrarian, the bad news that you just talked about, everyone knows. And we've seen that over the last 3 months. It doesn't continue forever, and it's masking the really powerful stories you're seeing elsewhere. As soon as that stabilizes, then the oversold, unloved, cheap growth names that we see should start to outperform. And that's exactly what happened in ASEAN, as I said last year. So countries like India, the rupee has been a little bit weak. We expect about a 5% depreciation each year. India has 600 billion of foreign exchange reserves. It's kind of in line with where we expect. If you're making very strong returns in the Indian market, as has been the case over the last 5 years, then you'll lose a little bit in the currency, but you'll still end up with a very good return. And that chart I showed you with the sterling returns for India last year certainly justifies that. So we would like to think that the worst of the currency weakness in emerging is largely there or thereabouts, and the specific fundamentals will start taking over exactly as they did last year.
Thanks, Mike. Last question, because the time is running. Which will you buy, Alquity Future World or Alquity India? And I will add, or both.
They're designed to be complementary. India is clearly one of the best equity stories on the planet, and in our view, and it is uncorrelated with other things. It deserves a standalone allocation in the portfolio, and you're seeing that happen more and more these days than was ever the case 5 or 10 years ago. So it wins on its own merits, and the geopolitics and the Trump, that's the icing on the cake. However, not everyone wants to own a single country allocation. Sure, then you can broaden out with Future World. But equally, Future World gives you, the GEM Fund gives you a lot of stuff you don't get in India. The amazing stories in Saudi Arabia, which reminds me of India 20 years ago, or Greece, or Egypt, or Argentina, or ASEAN, which is super cheap. Some of the AI beneficiaries that are still going to do well, regardless of recent news in Korea or Taiwan. So the answer is both. They are very complementary. Both are uncorrelated fundamentally with what's going elsewhere, and they're designed to be core and satellite. So you can add both, and they both fit very well with the US allocation, in our view.